Hey everyone, and welcome to This Explainer. Today, we're diving into a topic that can absolutely rewrite your financial future: demystifying investing and building wealth with small capital. We're going to cut through all that confusing financial jargon and look at the actual nuts and bolts of putting your money to work. We're drawing on some fantastic source material today that proves a really empowering point. Building wealth is absolutely not about having a massive pile of cash on day one. It's actually about structure, understanding the math, and being super efficient with whatever capital you do have.
Okay, let's dive into this, because right out of the gate, we've got to confront the biggest anxiety that stops so many people from even trying. Do you need a lot of money to start investing? I mean, if you just casually watch the financial news, it's all billionaire hedge funds and massive corporate buyouts, right? But the reality for everyday folks like you and me has completely changed. That old assumption that you need a huge war chest just to get your foot in the door, it's completely outdated. So let's shatter that misconception right now by looking at the myth versus the truth. The myth is that investing requires a large amount of money. But the truth? You can start with literally just a few dollars a week. See, investing used to mean calling up a broker, paying exorbitant fees, and having to buy whole, expensive shares of stock. But modern platforms have completely democratized the market. We've moved into this incredible era of zero-commission trading and fractional shares. The barrier to entry is basically gone. The whole system is now built to let you jump in with tiny, micro-deployments of capital.
Which brings us to our absolute secret weapon here: consistency and compounding.
It turns out a surprisingly small amount, literally just a few dollars, is the true engine of financial success. We're talking about $5 a day or maybe $20 a week. It really isn't about saving up a giant lump sum and trying to perfectly time the market. It's about consistency. By methodically putting a few dollars into the market at regular intervals, which is a strategy called dollar cost averaging, you smooth out the market's crazy roller coaster rides. You're just steadily accumulating assets, week after week, whether the market is going up, down, or sideways.
And here is where it gets really fun. You reinvest your earnings to unlock the power of compound interest over time. Think of it like a snowball rolling down a hill. When your tiny investments earn a dividend, you can use an automatic reinvestment plan, often called a DRIP, to buy even more fractional shares. So you aren't just making money on your original few dollars anymore. You're actually making money on your money's money. And the earlier you start this loop, the bigger and faster that snowball gets. Time is absolutely the ultimate multiplier here.
So, where exactly should you put those few dollars? Well, let's talk about choosing smart, diversified assets.
Now, what's really interesting about this slide is the concept of diversified assets. This simply means investments that spread your risk across a lot of different companies to provide really solid long-term returns. Think about it. If you put all your cash into one single company and they go bankrupt, well, your portfolio takes a massive direct hit. But if you spread your capital across hundreds of companies, one bad apple doesn't ruin the bunch. You're basically tying your money to the overall upward growth of the entire economy.
And our source material points to 3 specific, historically proven vehicles for doing exactly this: broad stock market index funds, exchange-traded funds or ETFs, and retirement investment accounts. These are honestly the most ideal starting points when you're working with smaller capital. Why? Because index funds and ETFs give you that instant broad diversification, and they charge incredibly low fees. You aren't losing your cash to some expensive money manager. Plus, using tax-advantaged retirement accounts protects your growing wealth from being eaten up by taxes over time.
Now, we absolutely have to talk about the mindset shift here. A steady growth strategy versus speculative get-rich-quick schemes. You've got to avoid the temptation of fast money gambling. Chasing whatever volatile asset is trending on social media might sound thrilling, but it introduces huge, unnecessary risk to your hard-earned money. Smart strategic investors, they completely ignore all that noise. They trade the adrenaline rush of gambling for the reliable, mathematical certainty of long-term compounding.
Of course, before you go throwing every spare cent into the market, we need to focus on building a balanced financial plan.
Let's move to and see how this builds into a highly actionable 3-step checklist. Step 1, maintain an emergency fund. You absolutely need cash set aside for real life, flat tires, unexpected medical bills, so you don't ever have to sell your investments in a panic just to cover rent. Step 2, reduce unnecessary debt. Look, high-interest credit card debt will mathematically eat your investment returns alive. You've got to clear that toxic debt out. And finally, step 3, invest for the future. You really only hit the gas on investing once those first 2 safety nets are firmly in place.
And to keep that plan rock solid, you have to continue learning. Focus on personal finance, market trends, and risk management. An informed investor is a safe investor, right? When you actually understand how economic cycles work, a market dip doesn't freak you out. You rely on data and strategy instead of panic.
And that constant learning feeds perfectly into our final concept, the long-term investor mindset.
So, the crucial point is establishing unwavering discipline during market ups and downs. Market fluctuations are completely normal. The market breathing in and out is just what it does. Maintaining a long-term discipline is your shield against panic. When the market dips, a smart investor doesn't jump ship. They stick to their dollar-cost averaging strategy. In fact, long-term investors kind of love market dips because it means those fractional shares are basically on sale.
And this brilliantly illustrates the core thesis of our explainer today. The best time to start investing was years ago. The second best time is today. The tools for wealth creation have literally never been easier to access, and that financial barrier to entry has essentially been wiped out. The whole system for compounding wealth with small capital is sitting right in front of you, just waiting to be used. So the real question is, are you going to let short-term noise and hesitation hold you back, or are you ready to let time do the heavy lifting for you? Thanks so much for joining me today. Keep learning, and definitely stay disciplined.